Okay, we're almost to the end. Today we are going to look at different types of loans, and I'm going to give you a quick explanation of different ones. Well, first one's a credit card loan. And really what that is that the credit card company gives you a credit card, which really enables you to take a loan and purchase goods on that credit card. You can also take cash out on that credit card as well in some cases, but that credit card loan is based to the credit card company, and they really pay your bill for you, whatever you're borrowing, and then they charge you interest on it. Or they give you cash. These are usually high interest loans. They're also revolving loans, so while you own the credit card and it is open, you can continue to borrow from them and pay them back. It's a great way to build your credit. All of these loans are great ways to build your credit, most of them. Um, but there's an understanding that these are usually higher interest rates because there's a higher risk for the credit card companies. Also, home equity loans. Home equity loans means that you may have already purchased your house and had it paid off, or you um, are purchasing a home. That's a mortgage. Then some people take a second mortgage or a home equity loan on the capital that's left. So, for example, you have a house that's worth $100,000, and it's paid off. You could take a home equity loan on a house for $20,000, and it's usually a maybe 10-year, depending if it's a line of credit or if it's a home equity loan. A home equity loan will probably last you 30 years. And you borrow that money on the value of your house, and it's usually a lower interest rate, and you can pay off higher interest rate credit cards and debts with that. Um, it also is set up like a mortgage with a home equity loan where you're paying over 30 years and it's amortized where you're paying the interest at the beginning of the loan and more the principal towards the end of the loan. If it's a home equity line of credit or a HELOC, you pay as you borrow, which is the same type. You're borrowing money on the value of your home on a low interest loan that you pay back over a period of time. In some cases, HELOCs, you only have 10 years to pay them back. You can extend it, but it's usually a short-term, lower interest loan. So there's a couple of types of home equity loans. You're really just borrowing in the equity of the house. Installment loans, well, everybody knows what an installment loan is compared to it is something that if you were buying a car is an installment loan, or sometimes people buy appliances or furniture or boats or computers or whatever. They can get an installment loan, which means you pay an equal amount over the period of the loan plus the interest rate to come up to a certain amount. For example, a car loan you pay for 60 months, $500 a month till the car's paid and the interest is paid as well. That's an installment loan. Most installment loans allow you to pay them off sooner, and then you'll pay less interest over the loan because the actually interest is calculated over the length of the loan, and if you pay it off sooner, then you're paying less interest on the loan. That goes for the same on a home equity loan, and as actually credit card loans, if you pay them off every month, you don't have to pay any credit on them. But a lot of people keep a running balance on credit cards, and then you're paying interest on that running balance. Life insurance loans, well, this is just a loan on your life insurance policy. Let's say you have and it depends, there's a whole life policy and a term life policy. I'm not going to go into details, but a term life policy, you pay a certain amount every month, and if you live past that term, you don't get anything. Um, so you're kind of gambling against the life insurance company of whether or not you're going to outlive the term life policy. A whole life policy, you're usually costs you more. You're putting money into a policy and they're saving it and investing it for you so that if you do outlive the policy, you can then take the money um, out of that policy, or you can borrow it with a life insurance loan, or you can cash in the policy. If if you live past, let's say, a 30-year term life, then it will still be good. It will still continue to grow to pay off um, your heirs in case of your passing. These are things that you really should get a financial advisor for so they can go over it with you in detail. I know when you're younger, you don't think of any of this stuff. When you're older and you have children, then you start worrying about it. But the best thing to do is get in when you're younger because the rates are lower because they're gambling you're going to live longer. When you get older and decide to do this, it usually costs you more for waiting. So find a financial planner and work with them. It's very important. All right, margin loans. Well, a margin loan is really money that you're borrowing against a stock or bond. Let's say you open up an E-Trade account and you deposit $2,000. They'll give you a margin loan, which will allow you another $2,000 for a total of $4,000 to invest into stocks or bonds and long-term investments. They're usually low interest rates and are a great thing to double the amount of money that you're able to invest, which then speeds up your process if you make money. They can also be very difficult, very dangerous because if you lose money, you're losing twice the amount of money. Um, so margin loans are usually a lower interest rate that you use to the money to invest into some type of security, and a security is a stock, bond, mutual funds, commodities, so forth. A mortgage loan, just a little different than a home equity loan. A home equity, you have your house paid for and you're taking money out of it. A mortgage is when you're purchasing a new house. A lot of mortgage companies will try to give you, instead of a home equity loan, if your credit's not good, to refinance your mortgage, and that's the difference. You're getting yourself into another mortgage. You're paying off your old mortgage with the new mortgage, and you're going back to a 30-year fixed or whatever type of mortgage you're using, 15 or 30. My advice is never get an ARM. There's never a good reason ever to get an ARM on your loan, and always go with a fixed 30, 15, 20, or 30 year. That's my advice to you when you do decide to get a mortgage. But a mortgage really is you're buying a house, you can't afford the house up front, so you're going to make payments for 30 years to pay the house off. And that's how most people purchase houses, especially nowadays with the cost of houses. Most people don't have $200,000-300,000 saved in the bank. Now, after you've done all of this, and in about 5 or 10 years, you will, if you follow all these principles, and you will thank me when you pay cash for your house. It's so much cheaper to pay cash for things. What's a retirement plan loan? Means that you put your money in your 401k or retirement fund over a period of time, and now you need to borrow money on that. Therefore, it may be 5 to 10% interest rate, and you can take money out of that retire. You're really not taking money out of the retirement fund. You're borrowing money with the collateral that is in your retirement in case you can't afford to pay it back. So these are different types of loans, and before you take any of these loans, do your research, read up about them, and make sure you read the contracts themselves in detail. All right, thank you. We have 2 days left. It's getting ready to review and find out if anything happened with your disputes and where to go from there. Thank you, and I'll see you tomorrow.